If every country on Earth is in debt, who's the creditor? It's one of the strangest riddles in modern economics. Every government, from the United States to Japan to Germany, owes trillions. But if they all owe money, then who exactly is lending it? Is there some hidden entity above nations, quietly pulling the strings of global finance? Or is the truth buried deep in a system so complex, we've stopped questioning how it actually works? Because this isn't just a riddle. It's the foundation of the global economy itself, and to understand where the money really comes from and who it's owed to, we have to go back, way back, to the moment money stopped being real. For most of human history, money meant something tangible. Gold, silver, copper, physical metals you could hold, weigh, and trade. For centuries, nations built their power on these metals. The gold in a country's vault was its strength. If a government printed more money than it had gold to back it, the currency collapsed. That system kept rulers disciplined, until it didn't. In 1944, with World War II still raging, the Allied nations met in Bretton Woods, New Hampshire. Their goal was to rebuild a shattered global economy and create a stable system for trade. What they designed would become the backbone of world finance for the next generation. It was called the Bretton Woods system. The US dollar would be the world's reserve currency, and it would be backed by gold. Every other major currency would be pegged to the dollar. It sounded perfect. Stability, structure, trust. But behind that trust was one crucial assumption, that the United States would always have enough gold to exchange for its dollars. By 1950, the US held over 20,000 tons of gold, the largest reserve in history. But as the decades passed, America began spending more than it earned. Wars, welfare, and global projects required dollars, billions of them, and other countries started holding more US currency than America had gold to redeem. By the late 1960s, the math stopped working. In August 1971, President Richard Nixon faced an impossible problem. Foreign governments, especially France, began demanding gold in exchange for their US dollars, as promised under Bretton Woods. But America's gold reserves were shrinking fast, so Nixon made a decision that changed the world forever. He went on television and announced that the US would suspend the convertibility of the dollar into gold. In that single moment, money lost its anchor. The US dollar, and by extension every other currency tied to it, was no longer backed by anything physical. It was the birth of what economists call fiat money. Fiat means by decree. The value of money was now based only on government order and public trust. At first, the world panicked. Economists feared inflation, chaos, even collapse. But something unexpected happened. Instead of falling apart, the system adapted. Nations discovered they could create money not from gold, but from debt. Once money became fiat, governments and banks gained a new power, the ability to create currency almost instantly. Here's how it works. When a government spends more than it earns in taxes, it borrows by issuing bonds, essentially IOUs, promising repayment with interest. Investors, institutions, and even other countries buy these bonds, providing cash to the government in exchange for future payments. But something deeper happens behind the scenes. Central banks like the Federal Reserve, the European Central Bank, and the Bank of Japan can buy those same bonds by simply creating new digital money. No printing press required. In other words, debt creates money. Every new dollar in circulation is someone's liability, an IOU backed by faith that it will be repaid someday. This is how the world economy expanded far beyond the limits of gold. Global trade exploded. Governments could fund wars, welfare programs, and infrastructure on credit. Corporations could borrow cheaply to grow faster than ever. By the 1980s and 1990s, global debt had grown so large, it wasn't just a feature of the system, it was the system. But this shift raised a haunting question. If money itself is created through debt, can the world ever be debt-free? The answer and the danger lies in what happened next. By the 2000s, every major economy was addicted to borrowing. Governments borrowed from their citizens, citizens borrowed from banks, and banks borrowed from central banks. And on paper, everyone owed money to someone else, but in reality, Most of the debt was owed within the system. Let's take the United States as an example. As of today, America owes over $34 trillion in national debt, but more than 2/3 of that is owed to itself to U.S. institutions, pension funds, the Federal Reserve, and American citizens who hold treasury bonds. Foreign countries like China and Japan own large amounts too, around 4 to 5 trillion combined, but even that is only a fraction. So when people ask, who does the U.S. owe all this money to? The real answer is us. The global financial system is a web of interlocking IOUs. Your retirement account may hold government bonds. Your bank's reserves come from the central bank's balance sheet. The central bank holds government debt as assets. It's a closed loop, and it only works as long as confidence remains. But what happens when that confidence breaks? In 2008, the illusion cracked. The global financial crisis exposed how fragile the system had become. Banks were over-leveraged, meaning they had borrowed far more than they could repay. Complex financial products, like mortgage-backed securities, spread toxic debt around the world. When the housing market collapsed, trillions in assets evaporated overnight. And governments did the only thing they could do. They created more debt to save the system built on debt. The U.S. Federal Reserve launched quantitative easing, printing trillions of dollars to buy government bonds and bail out financial institutions. Other countries followed. It worked temporarily, markets recovered, and growth returned. But the price was steep. Global debt didn't shrink. It exploded. By 2010, total world debt hit $150 trillion. By 2020, it surpassed $250 trillion. And by 2024, it crossed $310 trillion, or more than 3 times the world's annual economic output. The debt-based system was no longer a safety net. It was a trap. If you added up every government, household, and corporate debt on the planet and tried to pay it back, you'd quickly realize something alarming. There isn't enough money in existence to pay it, because every dollar created comes with interest. But that interest doesn't exist until new debt is issued. To pay off old debts, new ones must always be created. It's a treadmill with no finish line. And as long as the system requires constant growth to sustain itself, the debt can never truly be repaid. This is why recessions, bailouts, and monetary interventions keep happening. Each time the system slows down, central banks inject new liquidity, creating more debt to prevent collapse. But with each rescue, the system grows more unstable. Interest rates have to stay low to keep borrowing cheap. And when inflation rises, raising rates risks breaking the whole structure. So governments now face an impossible choice: inflate the debt away, or default on it. Today, the United States spends over $1 trillion every year just on interest payments, not even touching the principal. Japan's debt exceeds 250% of its GDP. China's local governments and property sector are drowning in unpayable loans. And Europe's central banks are quietly buying government debt to keep nations solvent. Globally, more than 60% of all money in circulation exists as debt. So when you hear that every country is in debt, it's not a coincidence, it's a design. The global economy runs on credit because credit is the modern form of money. And the creditors? They're not shadowy billionaires in smoke-filled rooms. They're pension funds, insurance companies, central banks, and indirectly you. Anyone holding a bond, a bank deposit, or a savings account is technically a creditor in this system. The real mystery isn't who's owed the money. It's how long the world can sustain a system that depends on infinite borrowing in a finite world. History shows us what happens when empires build their power on debt. Spain, in the 1600s, fueled by silver from the New World, borrowed heavily to fund wars, then defaulted 4 times in less than a century. France, before the Revolution, printed endless paper money through the assignats until inflation wiped out the middle class. And Britain's global empire weakened under massive war debts by the mid-20th century. Each superpower followed the same pattern: easy credit, rapid expansion, overconfidence, then collapse. And now, the entire global economy seems to be repeating the same cycle, but on a scale never seen before. The question isn't if the debt system breaks. It's how. Will it end through inflation that devalues currencies? A debt jubilee that resets the system? Or a digital revolution where central banks reinvent money itself? In response to rising debt and financial instability, central banks are already testing new tools. Central bank digital currencies, or CBDCs. These digital versions of national currencies promise faster transactions and more control over the money supply. But they also raise questions about privacy, autonomy, and the balance of power between governments and citizens. With programmable money, a government could track every transaction or even limit how, where, and when money is spent. For some, this could be the next step in modern finance. For others, it's the final step toward total economic control. Either way, it signals one truth. The debt-based system is evolving again. So, what does this all mean for you and for the future of global finance? First, money is no longer a store of value. It's a claim on future productivity, backed by trust, not gold. Second, debt isn't a flaw in the system. It is the system. Every loan, bond, and credit line is part of the machinery that keeps economies running. Third, the stability of this system depends entirely on confidence. The moment people stop believing in the value of money, the entire structure can collapse, just as it has, time and again, throughout history. So, if every country is in debt, who's the creditor? The truth is unsettling. The world owes the world. You owe yourself. And the entire system runs on one fragile belief that tomorrow's debt will be worth something today. But what happens when that belief fades? When the promises stop being trusted and the creditors are everyone and no one at once? Maybe the real danger isn't the debt itself, but the illusion that it can go on forever. Because every empire built on promises eventually meets the same fate, the moment when promises run out. And that moment may be closer than we think. If you found this video eye-opening, help uncover more hidden truths about money and power by subscribing to Wealth Untold. Because the story of wealth isn't just history, it's the blueprint for the future.